Good morning, everyone. Welcome to this update for global stocks and commodities for the 25th of September. And it was a very big week for central banks, with both the Bank of Japan and the Fed making major announcements. And they did pretty much what everyone expected. The Bank of Japan came up with a few variations, but basically there was no backtracking on ceasing stimulus at all. They're just continuing on along the same path as always. So markets basically took it pretty well. The Japanese stock market went up, the US stock market went up, and even gold went up. So it was a pretty positive week, and that certainly filtered through to the Australian market. Let's take a look at the action, but as usual, I just want to present a few comments in general, and also I want to cover I guess the key lesson that I've learned of this year, which is something that's been building now for several years, but is really becoming very, very evident in the market action these days. So I think it's probably one of the most valuable messages that I can give you. But let's start initially with just some general comments about what's going on. The weight of evidence just has to be bullish. Around the world, there's really no way that I think you should be listening to the people that are calling for a major market top or the next market crash. There's just too many things that are in favour of this bull market continuing. Now that doesn't mean that it's going to be an absolutely rip-roaring bull market. I think it's probably likely to be more gradual. But last week I provided some both fundamental targets on the S&P of at least 2,300 based on earnings and valuations, and also provided some technical targets which would easily get to 2,300 or above, possibly 2,500. Now that might take a little time to get there, but to me the overwhelming weight of evidence is to the upside. But what could go wrong? I don't think it's going to. These are more intermediate impacts, if you like. I don't think they're going to change the big picture. But they certainly could cause some short to medium term disruption, and probably scare the daylights out of most traders and investors around the world. So let's have a look at what could go wrong. I've been saying all year that concerns about the European banking system, and in particular the Italian banking system, are a real concern. And I've shown the chart of Deutsche Bank on several occasions, and I want to take a look at a couple of other of the banks as well. I want to look at Credit Suisse, I want to look at the Royal Bank of Scotland, and also in Japan, which is obviously a bit of a financial basket case as well. Look at Mitsui, which is one of the top 3 or 4 largest banks in the world. So let's jump in and take a look at those charts. So we'll start first of all with the chart of Deutsche Bank. I've shown this a number of times. You know what the big picture looks like. Used to trade at 160, and you can see the lows at the bottom of the GFC were 22, and you can see now that we've basically been below that level since February. So pretty much all this year we've traded below the GFC lows, and you can see just the steepness of that downtrend, and we're still forming basically lower highs and lower lows. A little bit of a trading range there at the moment, but it's right at the bottom of the trading range, and you'd be a pretty brave person that would be calling a bottom in the price of Deutsche Bank. Let's look at Credit Suisse. Pretty similar sort of pattern. Let's go right back and see what it used to trade at. Used to trade up at $80. Now it's trading at about 11, 12, around that area, and you can see of late very, very steep decline. We've got a basing formation, but really no evidence that it's coming out of that basing formation. And you compare that with most other sectors around the world, and even the banking sector elsewhere around the world outside of Europe and Japan, and it's terribly negative price action. Let's look at the Royal Bank of Scotland. I'll just show you the big picture. Used to trade at up around 160, and now it trades for about $5, I think, when we zero in. There we go, trading for about $4.77 at the moment. And let me just have a look at the final one, which is Mitsui Bank. So this is certainly one of the bigger banks, or the biggest bank in Japan. Used to trade up around 17, now we're down at 5. So you can't look at these bank charts and make any other conclusion other than very significant parts of the global banking system is in serious trouble. If they weren't, the share prices would not look like this. So whatever else you know about economics or you know about banks, you've just got to look at that price chart and you can only conclude that there is some serious trouble. And if some of the world's biggest banks fall apart, then we're in for some significant trouble. However, central banks may just keep coming to the rescue. But if they do that, then of course that's going to be very positive for gold, because it's just going to mean more and more money printing, more and more distortion of the financial system. The second thing that might go wrong is that there are some hints now that central banks may be switching from a purely monetary stimulus, in other words, money printing, and they may go back to something a bit more normal, which is more of the governments providing fiscal stimulus. In other words, governments going deeper into debt, but hopefully to create infrastructure which is net positive, or should be net positive, for the economy. So I think that's only a very short-term thing, but markets may react badly during that transition process because they've been so used to stimulus now for so long. A geopolitical event, of course, Middle East, North Korea, South China Sea. There's plenty of them around the place that could cause some short-term disruption. And of course, the uncertainty, if Donald Trump wins the presidential election, then that will create enormous uncertainty, and markets hate uncertainty. So there certainly are things that can go wrong, and that's why I think we will continue to see a period of volatility, albeit within an overall uptrend. I focus a lot on new emerging trends and also existing trends. And as I pointed out last week, we've got precious metals, we've got energy, probably still a little early for energy, but that's one you want to be watching. China is also has a great deal of appeal to my mind, and has excellent long-term potential. And of course, anything related to the new economy, technology has got very strong tailwinds. Now, turning to what it is that I've learned, particularly this year, the first thing is that the long-term successful strategies that have worked in the market for a long period of time, and a lot of technical indicators that have, where A equals B, you would normally expect if A occurs, then B would be the result. Well, a lot of those things have really stopped working. And this is not just a gut feel. This is some of the research that I've read by some American research companies that have gone into this in great depth, going back 4 or 5 decades, and they've demonstrated statistically that there's been a massive shift. The strategies that used to work and provide a positive result in the market are now providing a negative result, and vice versa. The things that didn't used to work at all are now providing actually a positive result. So there's been a complete flip-flop. I think there's 2 main reasons for that. First of all, quantitative easing has just so severely distorted global asset pricing and created a perceived floor under the market. So traders no longer fear that the market's going to fall too far, because they're confident that the central banks will step in and prop the market up. And of course, as soon as that thought takes hold, then people start doing irrationally stupid things. And secondly, and probably most importantly, is the rise of the computer algorithms, which so dominate trading around the world now. And there's various estimates as high as 70% of all turnover is not directed by a human being; it's directed by a computer program. So if we look at the algorithms, it's become fairly obvious that it's about short-term mean reversion is what's really occurring here. That's how the algorithms are programmed, and it explains why we're seeing so many V-shaped reversals and very large reversals on an intraday, well, not so much on an intraday basis for the reversal, but intraday we're seeing huge moves. If it's a day of selling, then the selling just goes on and on and on into the close, and then the next day, if it's a buying day, it just reverses the other way. And I just want to show you a couple of charts that demonstrate that. So we'll look first of all at the S&P 500 on a daily chart. Let's have a look at what happened around Brexit. We had this massive down day here, another substantial down day, so hugely negative sentiment, and then bang, bang, bang to the upside. I mean, no human being could possibly change their position from incredibly negative to incredibly positive in the space of 1 week. It's just not going to happen. They are computer programs that are basically driving a reversion to the mean process on a short-term basis. Let's come over here to the 9th of September. We had a massive down day. As you can see, the selling went all the way into the close because it closed right on its lows. The following day, the market gapped down, so still negative, and then by the end of the day, it had almost reversed the entire previous day's losses. And then the day after that, we're then back into negative again. You look at those 3 days, and that's really that's just being driven by computer programs that are just driving the markets in the very short term. So that's certainly what has changed. I'll just also look at GDX as well. So you can see GDX, we had a pretty negative period here. We had certainly 2 big negative days on the 24th of August and on the 30th of August. And then bang, 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 3 days to the upside basically took out a week of negative action. And then we're back into, so really this whole thing was just an overall consolidation. But you get these incredible moves to the downside and then equally sharp moves with lots of gaps to the upside. It's just got all the telltale signs. So one of the things that I've learned then is that you've got to be very, very clear about how to play this modern stock market game well. And the first thing that you need to do is to be totally clear about which game you're playing. And in my experience over the last 15 years with thousands of people working with thousands of people, hardly anyone is seriously really clear about what they're doing. And it's not a difficult thing to do. And it's one of the things that I really don't understand about human beings in the market is why it is that most traders and investors won't sit down and actually gain clarity over which game they're playing. You need to be clear about the main trend. There's no way that you can cross swords with the computer programs. You're going to come off second best every time. So the aim is to be very clear. Are you playing a short-term game? Are you playing the longer-term game? And just stick with the main trend. Don't try and trade all the lumps and bumps. If there is no strong trend, then don't play, is really the simple message. And just be cautious about buying breakouts, because generally breakouts will move a price to overbought in the short term, and then the computer algorithms kick in and drive it back down to oversold. Now, if you're a long-term trader, that's not necessarily a problem, but if you're a short-term trader, it certainly is a problem, and you run the risk of getting whipsawed in and out of the market. And also learn how to read the psychology behind the patterns, because the psychology behind the patterns are still applicable. The computer algorithms are written around with a knowledge of the psychology of the market. So as long as you understand what's driving the market behind it, then you can still use these things to advantage. All right, a bit of a long-winded introduction, but look, I think they're just such seriously important messages to learn. The S&P was up by 25 points on the week. The Fed and the BOJ pretty much delivered what was expected, and the market cheered. But I really do expect volatile conditions to continue. So don't think that whilst I'm pretty confident that we're still in a bull market. Don't think it's going to be a smooth bull market because I doubt very much that it will be. Last week I wrote that if 2116 on the S&P held, that would be a very positive signal. It did hold, and we also saw the Nasdaq set a new high as well. We saw the Russell 2000 trading pretty solidly, and basically in America the market depth remains very strong. There's just no denying that, and that's one of the key reasons why I remain firmly in the bullish camp at this point in time. The Aussie dollar went higher. I'll come back and look at those US charts in a minute. The Aussie dollar was higher to 76.2. Our index really rebounded strongly after being a real lagger for the last 2 or 3 weeks. It was up 134. That was mainly thanks to the banks. And as I've been indicating, it's just particularly after reporting season in Australia, and any company that disappointed in any way or didn't provide a really robust future outlook, they just got smashed by the market, and some of the moves were dramatic. So it's really critical to focus on the quality of the business and the earnings visibility that that business is projecting for the next couple of years. There's one of two ways to play the market, and I don't think you should be doing anything else. One is to buy the technical dip in a strong uptrend. So again, exploiting this reversion to the mean concept. Wait for the price to sell off, get down to oversold, and if then the strong uptrend will reassert itself. Or the other way, of course, is to identify the new bull markets that are emerging and start to build into them, but do it carefully, because bull markets, don't just start and roar off and never look back. Although gold did a pretty good job of that this year, but most bull markets will start in a very stuttering kind of way and generally be quite volatile. So you want to build carefully into them. So let's take a look at just a few technical things on the S&P. There's the monthly charts are still looking very strong, and this is the daily chart. You can see we ended up higher for the week. We didn't break. We've retraced to the 38.2, almost exactly, missed it by about a point. And you can see we've got a very clear uptrending channel here, and we're sitting around about the middle of that channel at the moment. So still looking pretty positive on the S&P, and let's look at the Nasdaq. There's the Nasdaq at new all-time highs. So really no questioning the strength in that market. The ASX 200, very powerful rebound. We're still in this 4,800 to 5,600 range that we've been in now since, got to go back to July of 2015, but certainly a very powerful rebound. While I'm here, we'll just take a look at gold. There's the US dollar gold price. So we had a very positive response to the central bank meetings, held up quite well, and just look at that on a weekly chart. You can see we've run up to the 38.2. Gold continues to consolidate just underneath it, and you'd have to think that the next move is probably towards the $1,500 mark. Let's look at GDX. So we've got a consolidation happening here. That there was some decent percentage moves to the downside on Friday night, but I noticed, particularly on GDX, but also looking across 40 or 50 different gold stocks in America, the volumes were generally the lowest volumes of the week. So this was hardly a move of conviction in gold. So gold was up 26 on the week. As I've previously alluded to, there's a lot of noise about when, if the Fed starts raising interest rates, that'll be bad for gold. It's just rubbish. History shows that that's not factual at all, that gold has actually done really well. In fact, just as one example, in the period 2004 to 2006, the Fed raised interest rates 17 consecutive quarters from 1% to 5.25%, and gold actually rose 73%. So there's one glaring example right there, where that perception that interest rates rising is bad for gold is just plain wrong. Low volume on the dips also supports the consolidation thesis that I put forward. There's no real enthusiastic selling, and even in the futures market, when we've seen liquidation of speculative longs in the futures market, we haven't seen the normal build up in shorts. Normally, the traders, move from long to short and back again. They haven't done that. They've liquidated their longs, they've taken profit, but they haven't built up on the short side. So no one's really prepared to make a strong conviction trade to the downside. So futures speculators, so they certainly do control the short-term action, but there are so many other factors that are driving the long-term, and they're nearly all positive. And look, I've talked about them all year, so I'm not going to go through it again. But just the process of if central banks don't move towards normalising interest rates and economic settings, then the system's going to break. There's almost no question about that, and that's one of the reasons that you're seeing all those European banks trading as they are, because that process of negative interest rates just doesn't work. So if central banks don't move towards normalisation, then the system breaks, in my view, and that's one of the big long-term drivers for gold. If they do move towards normalisation, then, as I said earlier, you've just got to ignore the noise that when rates start rising, it's negative for gold, because it's not true, it's not factual. So the long-term drivers nearly all positive for gold. Normal price and time correction, 3 to 6 weeks. We're now 5 weeks in terms of time, so I think this consolidation is likely to finish quite soon. And we haven't formed any lower lows at this point in time. So I think it's all looking pretty positive for precious metals, and we're coming back into a really positive time for precious metals seasonally. Looking at other commodities, copper rose to $2.19, which is certainly a sign of economic improvement. Crude oil was volatile, got up to 47, finished back at just under 45. There's lots of noise about production cutbacks, but it appears that the Saudis have lost their influence over the rest of the Middle East producers and OPEC producers. So I think we're going to continue to see this volatile action in crude oil. In the end, I think commercial reality will prevail, and that is unless the oil price moves back up towards the $70 mark, it's going to be uneconomic for a lot of new exploration to be conducted, and that will ultimately cause an adjustment process. There'll be less oil being produced because the existing oil fields will wind down in production, and without new discoveries, then eventually the supply and demand balance gets affected, and oil will move higher. So I think it's inevitable that oil trades higher. It's just a matter of when. So I just want to take a quick run through just as a perspective on the oil price. So this is looking at oil over the last 2 years. It's fall from 100. We've formed a bit of a base here now between 30 and 50. There it is over the last 6 months, bit of a tighter view. So you can see there's definitely a bit of an uptrend. It's a bit of a mild uptrend, but it's certainly there. And we're trading towards the top of that range. And of course, when we zero right in on the 3 months, which has really been between 40 and 50, then we're smack in the middle of it. So crude oil still consolidating. Here's our spot copper chart. Not much change there. So to wrap it up, this is what I wrote last week, and I just thought it was so important I'd repeat it again. You've really got to start to think like a considered contrarian these days. If you want to go with the crowd, and particularly if the crowd is trading what they think should occur rather than what is occurring, then you're going to find it pretty difficult. Look for signs in the cheap, out of favour sectors, because there will always be rebounds from oversold, and I covered some of those possibilities earlier. Exploit the short-term negative sentiment. The reversion to the mean trade is certainly alive and well. When it comes to precious metals, the elite precious metals businesses around the world are very profitable, and they're quite cheap from a valuation point of view. They have substantial leverage to the upside in gold. However, as I've said all along, I'm not looking for gold to take off as the basis for investment and trading in precious metals. There is still a considerable mean reversion process that has to occur, um, for to get gold stocks back towards a reasonable valuation relative to the gold price. So even if the gold price stays where it is, I believe over the medium to longer term, you're going to see gold and silver stocks still move up quite nicely. So that's it for this week. There's my contact details. The markets are really exciting. I've been talking about this now pretty much all year. The opportunities are terrific. They're they're challenging to get your hands around. They really are. And I talked about the volatility that we would see in the precious metals market. That certainly came through, and it certainly caused angst to a lot of people, but it was always going to happen. And that's why emotional control and clarity over your game plan is just such an important part of success. That's it for this week. Cheers.